Ever wondered how to invest during economic downturns? What if there was a way to protect your portfolio, even when the economy isn't at its best? Enter defensive stocks. These are stocks issued by companies that tend to perform relatively well during economic downturns or periods of market volatility. Now, how do they achieve this? Simple. These companies operate in industries that provide essential goods or services. We're talking about food, beverages, healthcare, utilities, and certain types of telecommunications. These are things consumers demand, regardless of how the economy is faring. So, in challenging economic conditions, these companies still maintain steady performance. And that's what makes their stocks defensive. They can act as a shield, protecting investors from the full impact of an economic downturn. Now that you know what defensive stocks are, let's delve into how one can invest in them. So, how does one go about investing in defensive stocks? Well, it all starts with identifying companies that offer products or services that are considered essential or relatively immune to economic fluctuations. These can be found in various industries and sectors, from consumer staples like food and beverages, to healthcare, utilities, and even certain types of telecommunications. Once you've identified potential defensive stocks, the next step is to access them. This can be done through brokerage accounts where you can invest in individual companies. But if you prefer a more diversified approach, you might want to consider defensive-focused mutual funds or exchange-traded funds, also known as ETFs. These funds pool together a variety of defensive stocks, providing a more balanced and risk-managed investment. Remember, investing is not just about what to buy, it's also about when to buy. Investing in defensive stocks can be a smart move, but knowing when to do so is equally important. Timing is everything in the world of investment. So, when is the best time to invest in defensive stocks? Now that's a million-dollar question. Well, investing in defensive stocks can be particularly advantageous during periods of economic uncertainty or market downturns. These are the times when the stability of defensive stocks really comes into play. Imagine a stormy sea with waves crashing and winds howling. In such turbulent conditions, defensive stocks act like a sturdy ship, providing stability amidst the chaos. They offer downside protection, shielding your investment portfolio from the worst of the storm. But it's not just during the tough times that defensive stocks shine. They also perform relatively well during calm market conditions, thanks to their steady earnings and cash flows. So, whether the economic seas are stormy or calm, defensive stocks can be a valuable part of your investment strategy. While there are many advantages to investing in defensive stocks, it's important to understand the potential downsides as well. Scene script. Like everything in life, defensive stocks come with their own set of pros and cons. Let's start with the positives. Firstly, stability. Defensive stocks typically have stable earnings and cash flows, acting as a reliable source of income for investors. This stability is particularly attractive during economic downturns or periods of market volatility. Secondly, protection. These stocks can shield your investment portfolio during market downturns or economic recessions, offering a safety net when other stocks might be plummeting. Lastly, dividend income. Many defensive stocks offer attractive dividend yields, providing a steady stream of income even during challenging times. But it's not all sunshine and rainbows. Defensive stocks do have their downsides. They often have slower growth compared to other stocks as they operate in mature industries with stable demand. They may trade at premium valuation multiples, making them susceptible to price corrections. And let's not forget about market timing risks. Timing the market and identifying the right defensive stocks can be challenging, potentially causing investors to miss out on opportunities for capital appreciation. Despite the cons, many investment gurus appreciate the stability and defensive characteristics of these stocks. Even the most successful investors in the world understand the value of defensive stocks. Warren Buffett, the Oracle of Omaha himself, has long championed the importance of investing in companies that offer essential goods and services. Benjamin Graham, the father of value investing, also stressed the significance of defensive investing in his teachings. Now let's delve into how you can measure the defensiveness of a stock. The defensive ratio formula can be a handy tool. This formula calculates the percentage of the stock's price relative to the overall market index, giving you a measure of its defensive characteristics. But that's not all. There are other methods as well. The beta coefficient, for instance, gauges the sensitivity of a stock's returns to changes in the market index. A beta less than 1 suggests the stock is less volatile than the market, thus defensive. Additionally, examining the dividend yield can be beneficial as higher yields often associate with defensive stocks. Now that you have a better understanding of defensive stocks, you're well equipped to make smart investment decisions even during economic downturns. Remember, investing is a journey, and every step you take brings you closer to your financial goals. Leverage on bullbearvector.com to find the right stocks and options to invest, helping you to save time and reduce costly mistakes today.